Welcome, everyone, to episode number 4 for the Real Estate Rabbit Hole. As we have done in the past, we're keeping our team very small, and because we only want experts on this podcast. So we haven't found anyone else in the marketplace that can compare to our expertise. So we've kept it to 2 folks. I am Dave Muir with Prime Lending, a mortgage lender, and I've been in the business 38 years. People can reach me at 410-241-7908. And I'm going to say I welcome again my cohort in crime here for Real Estate Rabbit Hole, Mike McGuire. Mike, say a few syllables.
Hey, Dave, thanks a lot. Yes, my name is Michael McGuire. I've been a residential real estate agent for 20-plus years. My phone number locally, 410-227-2483. I am an agent at RE/MAX Advantage. And a member of Team Kinnear, and home based out of Ellicott City, but I've actually sold properties in, I think it's 14 of the 23 jurisdictions in Maryland. So I am licensed in Maryland, can sell in Maryland, and have sold a property either with a buyer or a seller in 14 of the 23 Maryland jurisdictions. So
now, as we get into this, Mike, let me ask you, will you, if you have a buddy, will you show him a property in Deep Creek Lake? Will you drive to Deep Creek and show a property?
So it's a question. I actually, even when you say, like, if it's a buddy, I always have to be careful because you need to have some local expertise in the areas that you're dealing with. So it would really depend on, who it was, how, could I explain to them that, hey, maybe I never sold a property at Deep Creek. They have to understand that. I might need to reach out to, we have networks. RE/MAX has networks and things. So I might reach out to a RE/MAX agent in that area for some assistance and that sort of thing. So there has to be a certain comfort level no matter where you go. So again, it's not a question I can answer easily. I mean, I'd love to help everybody, but I have to be careful about, where my expertise really is. So
sure. And I do hear the cliche that all real estate is local, but the reality is what's the elasticity of the term local? Is it a half-hour drive? Is it an hour drive? Is it a 3-hour drive? And I think for different agents, and you're hitting my point and why I support your business so much and support you is because you're being honest. And you're saying, look, if I don't know the area, I'm going to reach out and get some assistance that can help us in the best way possible. And I think that's where all the professionals in the business need to be.
And this wasn't our topic for today. So this is, anybody listening, this is how you wind up in the rabbit hole. But,
absolutely. But there was another, I know you wanted to cover a couple other timely issues. So go ahead.
I do, and I will. But regarding this, one of the differences between my business and your business is that, again, I'm licensed in Maryland. I can only sell in Maryland when I only have a Maryland license. But if somebody comes to me and says, I need help in Virginia or I need help in North Carolina, again, I have a network of agents that I can reach out to, and I touch base with them in advance if I find someone who's a good fit for that particular client. Again, I can be somewhat involved, but I'm not the one who's actually handling the transaction. I get a partner of sorts in other areas to do that. You, on the other hand, how does your business work with regard to other areas?
Great question, Mike.
And that sort of thing.
And actually, it depends on the institution that you're employed with. And what I mean is, in my specific circumstances, Prime Lending is a federally chartered institution. We are part of a bank that is chartered in the state of Texas, but it has a federal charter. Name of the bank is Plains Capital Bank. So they, because of their umbrella around the 50 states being federally chartered, we are able to do loans in every state in the country. Now, with that said, there are some state regulations which mandate, and this is basically about 10 states where individual have to have either a physical office in that state, they have to physically be there in order to even take the loan application, or they have to have licensing they have to pass certain licensing tests that are specific and unique to that state. So there are some state that override, if you will, the federal charter, which would, say, prevent me individually from doing a loan in, say, the state of New York. I'd have to have a physical office there and be working there. It's a strong law in the state of New York. But there's some other states that say, well, we really will recognize your ability to do a loan here, but only if you take 40 hours of licensing tests per year, right? So when an individual one-on-one or one-off referral, I'll send that to one of our offices in that state. As a company, we do loans in every state in the union. And I can write mortgages in basically 42 of them myself. But for those that have additional state licensing, it does restrict us a bit. But we were going to talk more than just putting people to sleep about licensing. You had mentioned the other day in our conversations that you wanted to talk about kind of a timely matter, and it's always timely in the mortgage business, and that is the interest rate environment. So go ahead and, with the questions you had, even as a realtor, and that you get questions about, go ahead and fire those over, and I'll hopefully be able to lend.
Yeah, I was getting ready to circle back to that, Dave. Sorry.
I'm sure you were. I'm sure you were.
But I guess the main question or the first question that a lot of people have today is that, when the Fed lowers their rate, like there's so much talk in the news about the Fed rate, and they call that interest rates. How does that affect the actual mortgage rate? Like, why isn't it a direct impact on the mortgage rate?
It's not a lockstep, immediate change that takes place in the mortgage-backed securities world, which trades on almost a separate trading platform. And here's what I mean. The Federal Reserve funds, the Fed funds rate, is what banks can lend money to for overnight lending. So banks, for all of their lending, if you will, so banks pay attention and obviously have a vested interest in what the Federal Reserve is doing at any one time. Liens that are in second lien position on your home, i.e. a home equity line of credit, most banks tie them to what we call the prime rate. And the prime rate does fall or rise in lockstep with a federal funds rate announcement by the Federal Reserve. So if the Feds cut the rate a quarter, the prime rate will fall a quarter, same day, same time. What does not happen is the first mortgage interest rate world, meaning the primary lien on your property. And this residential real estate, can't speak to commercial, it's an entirely different business. But from a residential real estate perspective, mortgage-backed securities trade tighter to and more in line with, not in lockstep, but more in line with longer-term securities. So, whereas the Fed funds rate is overnight lending, short-term lending, the mortgage-backed securities, you can track those if you're a consumer by looking at more the 10-year Treasury bill rates, 10-year Treasuries, because most mortgages have a lifespan of anywhere from 7 years to 10 years to 12 years. Even though we take out 30-year fixed rates, many mortgages are paid off or refinanced, or there's a move, meaning a payoff. The house, the owners keep the house 7 to 10 years and then move. So from the standpoint of trying to track the direction of rates on mortgages, first mortgages, they really don't. The Fed funds rate does not have much of an impact other than perhaps the overall trend and direction of mortgage rates.
So it is beneficial somewhat when the Fed lowers the rate.
Yes.
It does sort of maybe show a direction overall, but it's
Correct.
definitely not a direct impact. Again,
No.
Unless you're talking about like a HELOC, which, again, as you started to talk about that, one of my questions right away, and I know the answer to this, but people may not. But what is a HELOC? and why would someone use a HELOC, or what are some different reasons why
Well,
someone would have a HELOC?
again, that question could take up a couple of our podcasts, but to make it short, a home equity line of credit is what the acronym HELOC stands for, and it's simply a lien put on your property most of the time now, by the way. It doesn't have to be in second lien position, but most of the time it is. People have a mortgage, they want to add on, they want to put a swimming pool, they want to add square footage to their home, they want to pay for very expensive college educations. We know about that. So, or they want to take a trip to Italy and spend 8 weeks there. Whatever the reason might be, they need cash. They want some cash. They have equity in their property. Equity defined as the difference between the value of your house and the balance of your mortgage. So they take out a second lien on the property, home equity line of credit. Most of them are tied to the prime rate, and there's a prime minus something on it, a prime plus 0, or prime plus quarter or 1, or whatever. Depends on your credit scores. A lot of factors that determine what the rate is. But a home equity line of credit is simply a mortgage, really, in second lien position. And you can draw it up and down. In English, that means it can work just like your credit card. So if you have a credit card with a $10,000 balance or $10,000 limit, and you charge on it 1 month $2,000, and you pay the $2,000 off, the next month you can charge $3,000, pay the $3,000 off. The next month you pay, you charge $500, and you might not pay it off. But the point is, the balance can go up and down as you need cash. So, in essence, the HELOC operates, think about this, and I know this is an old-timer's term, but it operates as a checkbook against your house. You literally can get a bank of checks that you can write on this line.
It's like an open line of revolving credit, correct?
That's exactly what it is.
So it gives you some flexibility. Sorry, it gives you some flexibility. There are lots of different types of HELOCs. Some are, some are revolving, some are not. Right? You can get a HELOC that's a straight up loan.
Correct. You can get a lump sum fixed rate second mortgage.
And if what I would say, so that we don't get off too much on that, what I would say is that if somebody has questions about a HELOC and how it works, and we have done HELOCs with clients of ours, even right at the time of purchase, for different reasons. And so again, it is another tool, or it is a tool in your toolbox that we can use. And again, different reasons for individual clients, just depending on what their need is. And it works great. It works great for some people. It's not for everybody, but it works great for some.
Correct. So it's a financial tool, and it's functional over many years. You can, most home equity lines have a draw period of anywhere from 10 to 15 years. So you can draw on them and pay it down, and draw again and pay it down, whatever. For many of them, have a 15-year window that you can take money out on. So it's quite useful from that standpoint.
So, I mean, as a lender, there are lots of different types of loans, and a HELOC is sort of a secondary one, or like lots of people know about those these days because they do have equity in their homes. Mm-hmm. And again, some people just set it up as like a security blanket. But when someone's initially buying a home, like why would one client maybe want a 30-year fixed mortgage versus a 15-year fixed mortgage versus a 5-year ARM? Can you talk a little bit about sort of the differences in some of those things?
Right. And the ultimate questions that I ask the client are, what are your future needs going to be, and game plan is going to be for this home? Will you be there 5 years? Will you be there 7? Will you be there 10? Do you plan on, and oftentimes, Mike, and I'm sure you've heard this, particularly with your first-time buyers, they'll sometimes just knee-jerk say, oh, we're going to be here 30 years. And the reality is that so few people today, not our parents, not talking about that generation, it's vastly different, But so many folks today who are purchasing their first home at the age of 33 or 38 or 40 don't stay in a home 30 years. They don't stay close to that. So if they want something shorter term, or maybe they're going to have the loan paid off in that shorter time of, say, 15 years, they might want a 15-year fixed rate mortgage if they can qualify for it. And the interest rate is always, always a good deal lower than on a longer term loan like a 30. Now, when we talk about adjustable rate mortgages, again, same questions. What's your game plan? What do you think your time frame is going to be? Because adjustable rate mortgages today, some
So when I asked the question, I said ARM, which
right,
the acronym for adjustable rate mortgage, just to clarify.
Exactly. We love, years ago, and again, we're going to go off tangent here. Imagine that, me going off on a tangent. But years and years and years ago, before I got in this business, I worked in the defense world. There were more acronyms in that building. I was there probably 4 years in total. And it took me those 4 years to figure out 50% of the acronyms they would throw out in a meeting, with the Air Force or whatever. I never figured it out. So hopefully we're not that confusing in the mortgage business. We use the term ARM, adjustable rate mortgage, simply to mean that at some point in the life of the mortgage, the rate's going to begin to adjust. And the time frame that it begins to adjust varies whether or not it's a 3-year ARM, a 5-year ARM, 7-year ARM, 10-year ARM. And when I say that, that simply means, that number means how many years you're in the home before it begins to adjust at all. So if someone's going to be, and they say to me, Dave, 5 years at most in this house, and they want to look at a 5-year ARM, that simply means that they plan on being out of the house in 60 months. They want to get something that's a little lower than market on a 30 fixed, and that 5-year ARM may work perfectly for them because there's no adjustment for those first 5 years. It's fixed rate mortgage for those first 5. Now, you might ask me, well, Dave, what happens after that? Well, there's a big it depends to that answer, and it depends on where rates are at month 60 as to what that ARM begins to adjust to. Most ARMs today adjust every 6 months once they begin to adjust. And the real risk, and this is probably the most important point about adjustable rates that I can make and that people really don't understand, and that's this. Once you go to closing and you sign a note on an adjustable rate mortgage, the term of the note is 360 months, 30 years. So here's the risk with an adjustable rate if you stay in the home past the time frame when it begins to adjust. Let's say you take out a 7-year ARM. It's great, fixed for the first 7 years. And then it begins to adjust every 6 months. The rate could actually fall at the end of the 7th year, depending on where rates are then. And the payment still go up. How? Because the mortgage, at the time it begins to adjust, is re-amortized over the remaining term of the loan. I don't want to get into the weeds here, but just know this. 3. If my math is right here, Mike, and you can check me on my math, because I'm not always there. But 23 times 12 is 276. So if at the end of 7 years, okay, the rate falls a little bit or is a little higher, it doesn't really matter. What's going to happen is the lender's going to take the principal balance, the new rate, and amortize the payment over 276 months, not 360 again. And that's the risk of an adjustable rate mortgage. The term never changes, the term toward your payoff. So when you keep an adjustable, your rate might fall. There were years there where the Treasury bills stayed really low. People's adjustables kept falling or staying low, and they loved it. But the payment, depending on how much principal's been paid down, the payment could still technically go up. So understand that's the inherent risk of an adjustable. Not so much the rate and what the rate does, because a lot of times, over the past 10 to 15 years anyway, the rates haven't moved much on adjustables. And that's a general comment. And that's going to change, I'm sure, over the next handful of years. But
what I think
does that explanation make sense to you as someone in the business? Because if it doesn't, I can go further with that. But that's the main risk.
Well, what I'm taking away from this, and what I think anybody listening should take away from this, is that you need to have an expert who understands all these things. You can't just hear someone at a party throw out like, well, just get an adjustable rate. It might be the perfect scenario for you, but if you don't understand about the reamortization at the end of your arm, that's the risk that you're taking. And you want someone who can explain to you the good, bad, and ugly of whatever it is about the real estate transaction. I think something that Dave and I both do well is we try to inform clients, educate clients, and make sure that they know if you're picking a certain thing, if you're using a certain contingency, if you're going for a certain type of loan, that okay, it's the good part of that is this, the bad part is this, and these are the way, we're trying to predict how things might come out, but it's ultimately the client's choice, and you need to understand those things. And if you don't, you better find somebody who can answer these questions and who sort of even points out, hey, this could happen. At the end of that time, the rate could go down, but your payment still might go up some. And obviously, that's even notwithstanding insurance and taxes, which never seem to. They rarely.
By the way,
down.
That's a topic for another podcast. By the way,
yes, but but if nothing else, take away from the fact that you can't just hear something. Lots of people talk at parties. Lots of people, it might have been someone who had success with a certain type of loan program or with a certain type of contingency on the real estate side. But if you don't understand what that is and maybe why that worked for them, and you don't have an agent who can explain it to you or a originator who can explain it to you, then you could be putting yourself into a bad spot or setting yourself up for something where you say like, well, I didn't remember that. I didn't, nobody ever told me about that. Well, that's why you have to have people that are looking out for your best interest. So
the other thing I didn't mention here is from an adjustable rate standpoint, they're not always lower than where fixed rates are. Now, you might head scratch and go, what's he talking about? And it gets into some economic discussion that I don't want to go too deep into, but it's called an inverted yield curve, where short-term rates are actually a little higher than longer-term rates. So for, many, and let's face it, we go back to 2020 and 2021, when fixed-rate mortgages were 2.5% and 3%, there was no discussion about adjustable rate mortgages because, frankly, they were all a little bit higher than where fixed rates were. So it made absolutely no sense to even discuss taking out an adjustable rate mortgage. So know that your questions surrounding adjustable rate mortgages can be timely as well, in line with where the market is, at any one time. And that changes on a month-to-month basis. I mean, the market, as it moves, changes on a month-to-month basis. I did want to get back to the Federal Reserve question, Mike, before we finish, and I'll let you come out with your question. But one of the things about mortgage-backed securities, and has been the case now for the better part of 4 years since markets started to move north, beginning of 22, and has done nothing but really do that, and that's this. The market and traders pay really strict attention to the press conference right after the Federal Reserve chairman they come out of their meeting and make a decision to move the Fed funds rate. And whether they move it down or up, the traders really trade on the future, what they think's going to happen in the future. they bake in rate movements leading up to whatever the percentages and the tea leaves are reading about what they're going to do. The market will tend to move that direction. But then once they come out of the meeting, that hour-long press conference where he, and in this case, Fed Chair Powell, is in the seat now, answers questions. I'm telling you, as a consumer, you should pay more attention to that press conference the hour right after the decision's made to cut the rate than anything. You should pay strict attention to that because that's how the market seems to want to trade for the next 4 to 8 weeks. And that's what we're going through right now. And that's why interest rates for mortgages since the Fed fund cut of October 29, we've seen the market kind of do nothing but kind of drift north on mortgages, which is intuitively makes you crazy. But for the short term, that's what's happened because some of his comments about a future rate cut were not written in stone. I don't know what we're going to do in December. And that's all he needed to say. So just know that the Federal Reserve cutting the rate, yeah, it's important, and paying attention to that news ahead of time is important, but the press conference afterwards, it's gold. Believe me, it's gold.
Well, and what you're saying is that oftentimes when there's a cut on the actual mortgage side of things, that's already been factored in. They expected the cut. They expected the cut. So it's not a reactionary thing afterwards. It's a prediction thing beforehand many times. So oftentimes after he makes his cut or not, and again, the press conference is for some future prediction, but when he makes, when whatever happens that particular day happens, it's not a direct impact that the next day you see it go down if it went down.
Correct.
And again, there's multiple different factors that I do not understand personally. That's why I got to lean on Dave for all that.
Well, it's a myriad of factors, international too. But the reality is, in our industry, we still receive several calls the day of a Fed funds cut. Hey, Dave, Feds have cut the rate. I'm assuming mortgages are falling in the same direction. And we get that call, at some point that day or the day after. And it's like, no, did you listen to the press conference? Did you listen to what was said? And so, again, it's just word to the wise. Been doing this a few years, and we kind of see these things play out kind of consistently over the years. And ultimately, you and I, are we both hoping for rates in the mid-5s or low-5s? Absolutely. It will loosen some of this inventory. And we're going to talk about that on some other calls as we go forward in our podcast. But know that you got to pay attention to the press conference after the cut or after the increase.
Well, and be honest with everybody out there listening, we try to keep these to about 30 minutes so that they're manageable, listening in the car or whatever. So we're gonna stop this here pretty soon.
Oh,
but
yeah,
there's a ton of other things to talk about with regard to mortgages. Besides what we sort of touched on here, there's FHA type mortgages, there's VA type mortgages, there's USDA type mortgages.
The state has bond money.
Time and a place for all of these things. And what I would say is, again, you need to make sure that you're dealing with someone who's been in the business a long time and a professional who knows, they're not trying to fit you in a box. They're trying to listen to what your needs are and what you're trying to do so that they can help and guide you in the right direction. So I know that Dave does that. That's why I love working with him. And on the real estate side of things, again, you need somebody who's, working with the lender with regard to how you're going to structure offers, what types of contingencies overall. But again, the financing contingency is always an important one.
No question.
Again, that's why we work together. Again, my name's Michael McGuire. I'm with RE/MAX Advantage. My phone number is 410-227-2483. And I'll let Dave finish it off for today.
Mike, thanks so much again for your time today. I think we shared a lot of information that can be useful for folks who are looking to buy or sell. Don't time the market. Don't try to time anything. You're not going to win. It's just like a wealth planner will tell you. Never try to time your investments in the market. Stay in it. Make it happen. Dave Muir, Prime Lending, 410-241-7908. And we'll talk to you soon when we get to our next one. Enjoyed the time, Michael. Thank you. Take
All
care.
right, thanks, Dave.